In this video, I will show you 7 candlestick patterns going from basic to advanced patterns. I will also show you how to use these patterns in combination with price action to spot high probability trades. Now, with that being said, let's get started. So, what are candlesticks? Candlesticks are just a simple way of looking at the historical price of the asset. Each candlestick represents the price movement of the asset for a particular period of time. So, if we are on a daily chart, a single candle represents the price action for one day. On the chart, we see two types of candles: green candles and red candles. A green candle is formed when the closing price is higher than the opening price. This indicates that the buyers were stronger than the sellers. Similarly, a red candle is formed when the closing price is lower than the opening price. It indicates that the sellers were stronger than the buyers. Now, the reason why most traders use candlesticks is because it gives us a better understanding of the price movement. A candlestick consists of two parts: the wick and the body. The end of the upper wick shows us the highest price achieved during that time. Similarly, the end of the lower wick shows us the lowest price achieved during that period. When it comes to the candle body, things start to differ. For green candles, the lower end of the body is the opening price and the upper end is the closing price. And on the red candle, the upper end of the body is the open and the lower end is the close. Now, before we move on to the candlestick patterns, we need to understand a few concepts about candlesticks. Concept 1. Big versus small body. The body of a particular candle can tell us a lot about the strength or weakness of the buyers and sellers. For example, here we have two green candles. The candle on the left has a big body and relatively small wicks. The price of this candle opened down here. Initially, the sellers tried to push the price down. The sellers were very weak as the buyers quickly came in and took the price higher. Then the buyers were able to travel a lot of distance without any pressure from the sellers. As a result, the price closed very near to the high. This shows us that the buyers were significantly stronger than the sellers during this candle. On the second candle, the story is very different. The price opened here and the buyers started to move the price. They raised the price to a new high, but when they reached the new high, the sellers stepped in and took the price downwards. The sellers were very powerful and nearly covered the entire distance back to the opening price, but the buyers just about managed to close the price above the open. In this instance, we can see that the buyers were stronger than the sellers, but the difference between their power was insignificant. When the candle's body is relatively bigger than the wicks, it shows that either the buyers or the sellers were in control. On the other hand, when the body is smaller than the wicks, it shows that there was much less control from either side. It means there was a tough contest between buyers and sellers. Concept 2. Large wicks. Whenever we spot a large wick above or below the body, it gives us a strong clue about the price action. If we spot a large wick above the body, it shows us that the sellers are strongly selling on these levels. For the price action to move higher, the buyers will need a lot of effort. Similarly, if we spot a large wick below the body, it shows us that the buyers are strongly buying at these lower levels. If the sellers want to move the price lower, they must overcome these buyers. So, the concepts of body and wicks are essential moving forward. Keep them in mind as we begin to understand some basic candlestick patterns. If you're enjoying this video so far, then be sure to hit the like button and subscribe to the channel so that you never miss any of our new videos. Basic patterns. Pattern number 1. Bullish pin bar. A bullish pin bar is a strong reversal candlestick pattern. It indicates a potential reversal to the upside. A bullish pin bar consists of three elements: a small green body, a large wick below the body, and a tiny or no wick above the body. Let's understand the psychology behind this pattern. A bullish pin bar shows that the price opened around this area and instantly the sellers tried to take the price down. They were able to push the price down, but at some point the lower price triggered buy orders from the buyers. The buyers were significantly stronger than the sellers as they pushed the price beyond the open. Therefore, if we think about it, the buyers covered more distance than the sellers. It indicates that the buyers have stepped in and they are trying to take the price higher. If a pin bar appears after a strong down move, it indicates that the sellers have lost their strength and the buyers are now stepping in to move the price upwards. To trade the pin bar, we must look at other indicators to confirm our bias. We will discuss that later on, but if we find a buying opportunity as a pin bar, we can place a buy order above the high of the pin bar, and we can set our stop loss below the pin bar and target the next resistance. Pattern number 2. The bearish pin bar. The bearish pin bar is just the opposite of the bullish pin bar. It is a red candle with a small body, a large wick above the body, and a tiny or no wick below the body. It indicates a reversal to the downside. The psychology behind this pattern is very simple. The price opened here and the buyers started to move the markets upwards. They covered some distance and created this high. The sellers then begin to push the price downwards, crossing below the opening price. The sellers then manage to keep the price down and the candle closes near its lows. This indicates that the sellers have momentarily gained an advantage over the buyers. If we find another confirmation at this point, we can place a sell trade below the low of the pin bar and we can keep our stop loss just above the pin bar. 3. Doji. The doji pattern is probably the only candlestick pattern that does not give us directional bias. However, it is essential to understand this pattern. A doji candle is characterized by a candle with approximately equal wicks above and below a small body. The open and close are somewhere in the middle of the candle and the body of the candle is very small. It shows us that the buyers and sellers were very competitive during that time period. The sellers try to push the price down while the buyers pushed the price upwards. In the end, they were both equal to each other and the price closed near the open. In itself, the doji tells us nothing. It can only indicate a momentary pause in the move. But if we see a few doji candles in a row, the buyers and sellers are battling for a win. Usually, after such a pattern, the price will generally break out, a wild move in either direction, so just keep that in mind. The 3 patterns covered up until this point were single candle patterns. Now we will move over to intermediate patterns that consist of 2 candles. Pattern number 4. The bullish engulfing bar. A bullish engulfing bar is a 2-candle pattern where a green candle completely engulfs the red candle before it. This means we first see a red candle, then the next candle is a big green candle that completely engulfs the red one. The high of the green candle is higher than the high of the red candle. Similarly, the low of the green candle is lower than the low of the red candle. The psychology behind this pattern is pretty simple. The sellers were in control during this red candle. Then, as the new candle opened, the sellers took the price lower, it broke the previous low, and suddenly the buyers stepped in. They overwhelmed the sellers and brought the price beyond the last candle's high. It shows that the buyers covered a more significant distance than the sellers. This means the buyers were now in control and ready to take the price higher. For the entry, we enter at the break of the high. We can place our stop loss below the low of the candle. As mentioned before, we want to see other confirmations like the price action, for example, to confirm the trade. Pattern number 5. The bearish engulfing bar. A bearish engulfing bar is a 2-candle formation where a big red candle completely engulfs the previous green candle. We first have a green candle, then the next candle is a larger red candle that completely engulfs the green candle. The low of the red candle is lower than the previous candle's low. Similarly, the high is higher than the previous candle's high. Now, let's understand the psychology of this pattern. First, we see that the buyers were in control as the price made this green candle. Then, as the next candle opens, the buyers try to push the price upwards. They managed to break above the high of the previous candle, then all of a sudden, sellers see these highs as an opportunity and they start to sell. Their selling pressure is so high that they manage to break beyond the low of the previous candle. The sellers traveled a lot of distance compared to the buyers, hence the sellers have now grabbed control of the markets. So we can place a sell trade below the low of this candle and we can set our stop loss above the high. Advanced patterns. Pattern number 6, the Morningstar pattern. The Morningstar pattern is a 3-candle pattern that indicates a bullish price reversal. The first candle is a strong red candle with a big enough body. The second candle is a doji or pin bar candle with a small body and large wicks. The doji or the pin bar can be red or green. Then we finally have a big green candle that breaks above the high of the doji candle. The sides of this candle will determine the strength of the pattern. If the candle is as big as the red candle, then it is a good trade opportunity. If it is smaller than the red candle, it is a low probability trade. Lastly, if the green candle closes above the high of the red candle, it is a strong reversal candle. The psychology behind this pattern is pretty simple. So, first we have a red candle. This shows us that the sellers were in complete control of the markets. They push the price downwards, then we see a small doji candle and it shows us that the buyers have stepped in and are pushing the price upwards. Soon the sellers lose their strength and the buyers take the prices higher, creating this green candle. It shows that the buyers have turned the price and we are now likely to see an up move. To enter the trade, we will place a buy order above the high of the green candle and we will keep our stop loss below the doji candle. Pattern number 7, the Evening Star pattern. The Evening Star pattern is the complete opposite of the Morning Star pattern. Here we have a 3-candle pattern where the first candle is a green candle with a considerably big body. Then we have a small doji candle with a very small body, and finally we have a red candle with a big body. The psychology behind this pattern shows us that initially the buyers were in control as they created this green candle. Then, soon enough, the sellers entered and started to challenge the buyers. As a result, we see this doji candle. The doji candle indicates that the buyers and sellers are in a tug of war. Then, finally, the sellers win the battle and they start to move the price down. So these were 7 candlestick patterns that can help you spot trade opportunities, but we are not done yet. We will now understand how to use price action concepts to find entries using these patterns. We will use support and resistance levels and trend lines to combine the candlestick patterns with price action. Here is an example. The price was in a downtrend, but it found support near this area. We see 2 reversals here and mark it as a support level. Then, the third time when the price arrives near the support, we expect it to find support, but we are waiting for a candlestick confirmation on the down move. Here we see that as the price approached the support, the candles became smaller in size. This was the first sign that the sellers were losing momentum. Then we see this doji candle form at the support. The doji is then followed by a large green candle indicating that the buyers had taken over the control and were ready to move the price. The green candle completed a Morningstar pattern. It was a strong pattern because the green candle broke above the high of the doji candle and the red candle before it. So a buy trade can be placed above the high of the green candle. We can place our stop loss below the pin bar and we can target this high. As you can see, the price moved up after our entry. Even if you missed that entry, you can see we have a second one waiting for us exactly here. The price made these 2 tops, creating a solid trend line. When the price reaches near the trend line again, we wait to see if the price develops some pattern. This red candle indicates that the sellers were trying to provide resistance at the trend line. The candle is followed by a large green candle that completely engulfs the red candle. It is a bullish engulfing candle. The low of the green candle is lower than the red one. The high is higher than the red one. Again, a very strong indication that the buyers have taken control and the trend line is not strong anymore. A buy trade could be initiated here as well. We place a buy order above the high of the candle and we can put a stop loss below the candle. Our targets will be these highs, and as you can see, the price achieved our targets on this trade. I hope you found value from this video and now know how to use these candlesticks for your trading. Again, the candlesticks alone are nothing. You need to combine them with other factors to create a system. If you found this video informative, then be sure to hit the like button and subscribe to the channel to never miss any new videos. See you in the next one.